Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first, OPEC Plus holds oil output steady, defying Venezuelan political chaos and a deepening Saudi-UAE fiscal rift. We'll analyse why the cartel is ignoring geopolitical shocks and how its high-stakes bet on Chinese demand could impact global oil prices. Second, a global economic split emerges as Eurozone's PMI hits a 48.8 low, while Asia's tech sector booms on AI demand. We'll explore how this divergence creates a two-speed global economy and what it signals for the euro and investors. Third, Canada's Micro-Condo market craters as an immigration policy shift sparks an investor race to the bottom and project cancellations. We'll examine how this investor-led collapse serves as a credit risk canary for the banking system and may create future housing shortages. A geopolitical bombshell just dropped in the energy markets. The United States has captured Venezuelan President Nicolas Maduro. This isn't just a political crisis, it's an oil crisis in the making. Venezuela sits on the world's largest oil reserves, and with the country's leadership in turmoil, you would expect oil markets to be in a flat-out panic. A while back, we walked through a very different kind of panic, one driven by too much oil, not too little, when the IEA projected a 3.8 million barrel a day surplus in crude even slipped under 60. That backdrop matters for how traders are reading today's shock. But here's where the situation takes a more complex turn. While the political drama is immediate, the impact on oil supply is not. Venezuela's oil production is what experts call a lagging indicator. Years of mismanagement and sanctions have left its infrastructure in such severe decay that the market is betting it will be a very long time before those barrels actually reach the global market, even with a regime change. And amidst all this, in what seems like a stunningly counterintuitive move, OPEC Plus has agreed in principle to keep oil output steady. No cuts, no hikes, just holding the line. So the thing is, this seemingly illogical decision is actually a high-stakes bet on a rebound in Chinese demand. China, after all, is the world's largest oil importer, so its economic health is a critical driver for oil prices. We previously analysed how China's crude imports posted a rare annual drop, an early signal of industrial slowdown, and today the focus flips. OPEC Plus is effectively wagering that the slump is bottoming out. China will soak up barrels and prices will firm. If they're wrong and China's property-led slowdown gets worse, they will have engineered a massive oversupply, risking a price collapse. This decision also papers over some serious cracks forming within the cartel itself. Tensions between key members Saudi Arabia and the UAE have flared into what's being called the biggest split in decades over the conflict in Yemen. We've warned before that fraying unity can morph into a 2020-style price war. The fracture lines we're seeing now make that risk feel uncomfortably familiar. When we place Saudi Arabia's fiscal needs alongside the UAE's, the contradiction becomes clear. Economists use a metric called the fiscal break-even oil price, the price a country needs to balance its budget. A while back, we highlighted estimates putting Saudi Arabia's break-even north of $96 a barrel. For 2026, the update is around $86. By comparison, the UAE, with its more diversified economy, only needs about $45 a barrel. This massive gap gives the UAE the freedom to push for higher production volumes, directly challenging Saudi Arabia's traditional role as the market leader. This rivalry could weaken OPEC Plus's pricing power for good. However, if you zoom out, you'll see another layer to this. The whole backdrop to this decision was a supposed massive oversupply that sent prices plummeting more than 18% in 2025. Remember, that narrative was fueled by the IEA's surplus call and the prospect of more Russian barrels if sanctions eased. But was it really a massive oversupply? Interestingly enough, we can check this narrative by looking at global inventory levels. According to the US, Energy Information Administration commercial crude oil inventories in the US are actually running about 3% below the 5-year average. This read challenges the glut story and suggests the price drop might have been driven more by fear and negative sentiment about a potential recession rather than an actual glut of oil. If those economic fears turn out to be overblown, the stage could be set for a sharp price rebound. So you've got a major oil producer in chaos, a cartel at war with itself, and prices already down, yet the group controlling half the world's oil is doing nothing. It's a calculated bet that the Venezuelan situation is a long-term problem not an immediate one. Analysts estimate it could take a full decade and over $100 billion in investment to restore Venezuela's production to its former peak. The real story to watch isn't just the headlines, it's the quiet data points. The cohesion within OPEC+, China's refinery numbers, and those weekly US inventory reports. They'll tell us if this high-stakes gamble is actually paying off. While OPEC Plus is making a high-stakes bet on China's recovery, the broader global economic picture is far from uniform. In fact, a massive economic divide is splitting the globe right now, with one continent's industrial engine stalling while another roars back to life, all thanks to artificial intelligence. This isn't just a temporary lag. The data suggests we're seeing a structural divergence, creating a two-speed global economy where different parts of the world are moving in opposite directions. Let's start in Europe, where the latest numbers are frankly worrying. The Eurozone manufacturing PMI just fell to 48.8, a 9-month low, signaling a deepening contraction. Now, for anyone unfamiliar, the Purchasing Managers Index, or PMI, is a crucial economic health check. It's a survey of companies asking about things like new orders and production. A number above 50 means growth. A number below 50, like the 48.8 we're seeing, means it's shrinking. Germany, the bloc's largest economy, recorded its weakest performance in 10 months. Italy and Spain also slipped back into contraction. And even within Europe, the story is fractured. While Germany's export-heavy model is struggling, France's manufacturing PMI just hit a 42-month high. This growing split makes it incredibly difficult for the European Central Bank to create a single monetary policy that works for everyone. An economist at Hamburg Commercial Bank put it bluntly, calling the widespread caution from companies poison for the economy. This caution is leading to destocking, where companies run down their inventories, creating a vicious cycle that slows the economy even further. We're seeing Europe's industrial sector struggle, while at the same time, Asia's key tech exporting nations are taking a completely different path. A powerful rebound is underway, partly as evidence of accelerating trade diversion as some Western nations de-risk from China. Taiwan's factory activity is expanding for the first time in 10 months. South Korea's just hit its first expansionary reading since September, driven by the steepest rise in new orders since 2024. Now, what's fueling this fire? The answer is a booming market for AI. These economies are global leaders in semiconductors, and they're benefiting enormously from the massive global demand for AI-related hardware. Believe it or not, we are likely seeing the start of a very narrow but very powerful global tech hardware replacement cycle. It's not a broad recovery. It's an intense boom focused almost entirely on AI infrastructure. One economist at S&P Global Market Intelligence noted that manufacturer confidence in the region just hit its highest level since May of 2022. Asian firms, unlike their European counterparts, are starting to restock, betting on continued strong demand. For Chinese-speaking listeners, this realignment of the global tech supply chain is a critical trend. It tests whether China's vast domestic market can offset shifts in export share, while also creating new opportunities and competition for industries across Asia. The situation presents a fascinating duality. On one side, European factories are exercising a caution that could poison their recovery, while on the other, Asia's industrial giants are ramping up production, powered by the global AI gold rush. For investors, this divergence will likely put downward pressure on the euro while favouring Asian tech manufacturers. The main thing to watch will be whether these trends continue in upcoming PMI reports and semiconductor export data. The risk, of course, is that this AI boom is narrow. If that investment falters, it could create a painful bullwhip effect of oversupply in the chip industry. That AI-driven boom in Asia is creating fortunes, but it's a stark contrast to another investment class that's getting absolutely hammered right now, Canadian real estate. Get this, in one of the world's most unaffordable cities, micro-condos that sold for $500,000 are now being dumped for 300,000 Canadian dollars or less. This isn't a correction, it's a collapse. One expert calls it a race to the bottom getting these things sold, with an unprecedented 18 condo projects cancelled in Toronto alone. You know, this specific market segment was uniquely fragile from the very beginning, and it's because of its heavy reliance on investors. Research from Statistics Canada shows a much higher concentration of non-resident ownership in condos compared to single-family houses, creating a house of cards that was ready to fall at the first sign of trouble. And the trouble came as a perfect storm. A sharp shift in Canada's immigration policies, combined with rising interest rates, created a brutal reality check. The policy shift in particular was what economists call a sovereign demand shock. For years, real estate prices were based on the assumption of perpetual government-driven population growth. When Canada announced plans to significantly cut the number of temporary residents, the foundation of that demand crumbled. We're talking about a change that Canada's Parliamentary Budget Officer projects will shrink the country's population by 1.4 million people by 2027 compared to previous plans. The result, over 60,000 new units were finished just as the market got, in one analyst's words, way too ahead of itself. What really brought this to a head was the type of selling we're seeing now, which is a critical warning sign. Many of these are assignment sales, where the original buyer sells the contract times to buy the unit because they can't get a mortgage or don't have the cash to close. This flood of desperate sales is what some experts call a credit risk canary. It's an early warning that the stress isn't just on individual investors. It's starting to test the resilience of the banks and mortgage lenders who finance these speculative projects. The market is now flooded with empty, unsold units. Ironically, this slump is not the solution to the housing crisis. It's actually creating what's known as a housing supply bullwhip. A sharp, sudden drop in construction today almost guarantees a massive supply shortage down the road. The Canada Mortgage and Housing Corporation, or CMHC, estimates that to restore affordability, Canada needs to build nearly double its current number of new homes every single year until 2035. But with developers cancelling projects, the country is moving in the opposite direction. So while renters are getting a temporary break, the real consequence of this market collapse may be a far more severe housing crunch in the years to come. The number to watch now is housing starts data. If developers stay on the sidelines, today's relief for renters will be temporary, setting the stage for a dramatic rebound in prices and rents once that supply deficit becomes painfully obvious.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.